Welcome back to Retirement News Online. One of the most significant transitions in life occurs when you retire from work. No longer will you be able to rely on a paycheck or regular income stream. Now, going forward, you'll be required to generate cash flow from a variety of sources you've already established. Then make sure that money can meet your needs for what could be decades. Joining us is Kevin Sullivan with Infinite Wealth Advisors in High Point, North Carolina. And Kevin, explain your view of transitioning a portfolio into retirement.
Sure. So transitioning a portfolio in retirement starts with what we consider to be the 40-60 rule, which is 40% financial management, which is management of the actual assets, and 60% behavioral finance. And the fact is that from a behavioral point of view, most people, when they're getting ready to retire, tend to make more emotional decisions about portfolio management, and that's not necessarily the best execution or best execution time. We find that if you've got a solid plan of action, that you minimize the amount of behavioral management that gets integrated into the decision-making process, and as a result of that, your success rate for retirement tends to be much greater.
Kevin, one of the common drawdown strategies is called the 4% rule. Does that still make sense these days?
So the 4% rule, in some cases, it can be used, and a lot of it depends on the client. So it depends on what the distributions are, it depends on what earnings are. It is typically used as a jump-off point. I've seen higher, I've seen lower. Obviously, the lower you are below 4%, the less risk you're introducing into the portfolio and the failure of a successful long-term retirement.
And now, how do you know when to take Social Security?
So taking Social Security is a pretty interesting question, and we get that a lot when people are coming in and they're trying to decide. Again, we use our 40-60 rule: 40% financial management, 60% behavioral management, and you want to manage the financial piece of it. The Social Security question is not a behavioral decision. It is a financial decision. It is a calculation. It is quantitative in nature, which means that it's just math. You've got to keep the behavioral management out of that process. There are few places where you can generate a guaranteed stream of income that will increase every year by some 8+% for every year that you don't take the distribution. In our case, we like to see people take it later. In some circumstances, people do not have the ability to do that because of financial circumstances, but our advice is always to have an advisor help you do the calculation, and keep in mind that it is a calculation and it is not a behavioral or emotional decision, as most people typically will make the wrong decision when they do that.
And one other aspect of good income planning is tax planning. Talk about why that's important.
So income planning and tax planning, a lot of advisors provide income planning, but do not provide tax planning. And just personally speaking, I don't know how you do that. Income taxes are a critical piece of the planning process. If not integrated within the plan, they can be detrimental to the distribution, or what we consider to be the decumulation of assets during retirement. So if your advisor is not providing income tax advice as part of their advisory plan, and income tax advice, by the way, does not mean you need to take this over to your tax planner and have them look at it and see if this is going to work. The advisor should be integrating the tax process and the tax planning piece into the plan and presenting that to you in an effective way so that you can understand and anticipate what income taxes are going to do to your decumulation and your retirement income.
That's Kevin Sullivan in High Point, North Carolina, and this is Retirement News Online.